are we currently in the state of the economy? I'm going to start, which is not a bullet point here, by saying that I had somebody today for the first time use the R word, recession, and being worried about a recession coming. I'm not worried about a recession, but I will tell you that there is reasons to be worried. So here's where we are today. So we're starting off 2025. The market analyst firms, IDC, Gartner, Forrester, they're all looking at the IT market growing about 9 to 12%. They don't see investment slowing down, and a lot of it is being buoyed by investments in AI, as well as the refreshing of the infrastructures to support AI systems. There's a lot of money being poured into professional services. The channel is actually a real beneficiary of this because it's the channel that's the one that's doing the implementation, the development, the migration work that's associated with a lot of the adoption of new technologies. And we're also going into a refresh cycle. So that's part of the reason why the channel partners are telling us, and this is in our channel forecast report, that they're expecting to grow 10 to 14% this year. Now, we exited 2024 with the US GDP growing at around 2.8%. Europe's GDP is anemic. It's, depending on which measure you go with, it's somewhere around 1%. China is slowed between 3.5% and 4%, but you also have to discount the Chinese growth rate by the way that they reported. So outside of the US, 2024 was not really a strong growth year. So we entered the 2025 at 2.8, and the forecast in January is that we were going to go to about 2.5, a slight slowdown, but not significant. Now that we're beginning to see where tariffs are going to hit and what they're going to do, they're now adjusting that to, we're going to end 2025 somewhere around 1.8 to 2. Still not a bad growth rate, but not a great growth rate. And so we do anticipate in the economy, the people that watch the economy more closely than we do anticipate that, the U.S. economy is going to slow, which means the rest of the world will slow correspondingly. There's also an expectation that interest rates are going to creep up above 3% again. Again, this is a byproduct of the tariffs. We heard just last week when we were listening to the distribution executives, they've stated very clearly that any impact on tariffs on the cost of products will just be passed on through the channel. Now, that's going to have its own problems. We saw this during COVID when inflation spiked and companies start raising their prices. A lot of partners got caught in the middle because they couldn't raise their prices at the same rate without losing business. So they ended up sacrificing profitability. So if the inflation rate goes back up, then we're probably going to see a little bit of some stress happening within the channel amongst the partners. They are anticipating that interest rates will decline by about 1% this year. So the Federal Reserve in the second half is expected to do a series of interest rate cuts, probably 25 basis points at a time. So somewhere around 1% will come down, and that will help ease some of the impact of tariffs, but it's not going to completely mitigate it. So what do we do know? Well, every day we seem to hear about a new tariff being imposed, so that's going to continue, and they are going to have an impact. They are going to increase the cost of inputs. The U.S. is a big importer of raw materials that are used in a lot of the things that we build and sell in the channel. So there will be impacts on the cost of finished goods. There will be, because of increasing inflation, increasing operating costs, not just to partners, but it'll also impact the vendor community as well. So we also anticipate that there will be a further tightening of channel budgets. We'll know more because we have our channel chief forecast in the field now, and that will actually take a measure of where channel budgets are. We do think that customers, as a result of all this, will probably start redirecting their IT budgets. So they're investing in automation now. That's probably where they're going to continue to make their investments because they're going to need to offset their operating cost. And what's the biggest operating cost is headcount. The thing to take away, and we have an article, it's on our site from the economist who was speaking at GTTC last week, Douglas Holt Eekman, and he was pretty clear that there's a lot of uncertainty, and that uncertainty is going to continue. And that's the thing that we just have to keep our heads on a swivel. This is not a static time. We do expect a lot of the indicators to swing. We don't know how. I mean, we talk with a lot of people who watch the economy. We monitor a lot of the economic monitoring services. Nobody really knows what's going to happen next. I think the positive side of this, though, is that the technology will be a catalyst for maintaining growth. It will be a catalyst for maintaining efficient operations. So it's not going to have a huge impact, but I highly doubt we're going to see the 9 to 12% growth that the analyst firms are projecting. And I rarely see partner expectation growth of 10 to 12% materializing. The one thing we do know is that when partners say that they're going to be growing at very high rates, they tend to come in above, not as much as they anticipate, but typically as much as 100% over the rest of market. So if IT spending slows to 5%, maybe they get to 8 to 10%. So it's going to be a healthy year for the channel, but it's not going to feel good. So I share that with you because it's not trying to, imprint you with some doom and gloom, but it's more around just to make you aware of the things that you really do need to be watching. And these are part of the things that we're watching as well.